Inflation is heating up again, just as AI mega spending and a record tech IPO test how much risk this market can absorb. You are watching vTalkInsight, Allocator's Lens Daily for June 12, 2026. Today we connect equities, rates, credit, and commodities around one question. Can resilient risk appetite withstand higher for longer policy and an energy shock that refuses to fade? Let's start with equities, where liquidity, leadership, and valuations are all in motion. In equities, the story is one of resilience colliding with rising macro tension. Despite geopolitical shocks, energy worries, and sector-specific drawdowns, global equity markets have held up well, with recent rebounds suggesting that risk appetite is still intact. Strong earnings are a key anchor, with reported growth running well ahead of earlier expectations and investors repeatedly using pullbacks as opportunities to re-engage rather than to de-risk. At the same time, higher bond yields and hotter inflation data mean the valuation cushion is thinner, so price moves are becoming more sensitive to macro surprises. Under the surface, leadership is changing. The largest U.S. technology platforms and high-growth names have moved from driving the rally to absorbing selling pressure, with several of the big 7 tech stocks now negative for the year and well below their recent highs. Recent weakness around large AI-related capital spending plans, including high-profile data center build-outs, shows that investors are no longer rewarding every ambitious capex announcement with higher share prices. Estimates now point to AI infrastructure spending running at well over $1 trillion per year, with upside scenarios even larger, but that scale is drawing sharper questions about returns, execution, and competitive intensity. The SpaceX listing crystallizes many of these themes, pricing at around $75 billion of new equity and a valuation above $1.7 trillion. It is being described as the largest IPO on record and a watershed moment for technology and space-related markets. Order books reportedly drew tens of billions from retail and institutional investors, while space-linked stocks and growth indices staged some of their strongest intraday rallies in months as pricing was confirmed. Yet the deal also concentrates risk with a tight initial float, enhanced control provisions for management, and the prospect of large passive flows and lockup expiries later this year that could amplify volatility and drain liquidity from other growth names. Beyond headline indices, breadth and positioning continue to flash mixed signals. Technology and related sectors now make up more than half of major U.S. benchmarks. Yet a significant share of underlying constituents are down year to date, underlining how narrow leadership has become. High price-to-earnings growth stocks have dramatically outperformed low multiple names, and several traditional bear market indicators suggest a late-cycle backdrop, including a surge in equity supply as buybacks slow and new issuance accelerates. At the same time, there is visible rotation toward industrials, healthcare, utilities, and select consumer names, helped by themes like defense spending, onshoring, and steady domestic demand. The macro overlay could become more challenging for equities from here. Producer prices are running at their hottest pace since early 2022, with energy the main driver, while real wages for U.S. consumers have turned negative and savings buffers are eroding. That combination raises the risk that companies will find it harder to pass higher input costs through to prices, pressuring margins just as wage demands and financing costs stay elevated. Balanced against that, the labor market is still resilient. AI adoption is boosting productivity, and some see oil prices easing back toward the mid-70s by year-end, which would relieve part of the inflation shock. For now, equity direction is tightly linked to whether earnings can continue to beat expectations while rates stay high, and how smoothly the market digests the SpaceX float and the broader pipeline of AI-driven issuance. Turning to rates, incoming data and central bank actions are reinforcing a higher-for-longer narrative even as bond markets trade with surprising calm. In the United States, producer prices in May rose about 1.1% month-on-month and 6.5% year-on-year, the fastest annual increase since late 2022. Energy costs were a major factor, with final demand goods up close to 3% and energy alone jumping by double digits. Yet Treasury yields barely moved on the day, suggesting that persistent inflation risk was already in the price or that investors view the spike as temporary. The front end of the U.S. curve underlines how much has already shifted. 2-year Treasury yields are now above 4%, and have risen roughly 75 basis points since Middle East tensions escalated, as markets price in around 40 basis points of additional Federal Reserve hikes over time. Some analysis points to the possibility of a 50 basis point move from the Fed between 2026 and 2027 if inflation remains stubborn, especially with producer prices and jobless claims hinting at stagflation risk. At the same time, the Fed's large balance sheet is seen as critical for maintaining liquidity, and any aggressive attempt to shrink it could unsettle funding markets more than the current policy path implies. In Europe, the policy stance is, if anything, even more hawkish relative to growth. The European Central Bank has now raised all three key rates again by 25 basis points and lifted its 2026 inflation forecast from 2.6 to 3%. Official projections suggest inflation will stay above the 2% target until late 2027, and policymakers have stressed that the risk of doing too little on inflation outweighs the risk to activity. Given that euro area growth already lags the United States, markets are increasingly focused on the possibility of a policy mistake if this tightening cycle continues into a weak backdrop. Across both regions, the common thread is that the earlier narrative of temporary inflation has largely disappeared from official discourse. Curve pricing now builds in higher terminal rates for longer, while investors debate how much additional tightening the economy and financial system can absorb. There is particular sensitivity to how the Fed communicates around alternative inflation measures and the balance sheet. Any perception that policymakers are massaging the numbers or tightening liquidity too aggressively could push long yields higher and weigh on risk assets. For allocators, the next focal points are incoming inflation prints, oil developments, and central bank messaging, all of which feed directly into the valuations and funding costs we see in equity and credit markets. Credit markets, by contrast, continue to signal a remarkably benign outlook. Investment-grade spreads in the United States are clustered around the mid-70s in basis points, while high-yield spreads near 300 basis points leave the overall risk premium historically tight. Commentary across regions highlights solid corporate fundamentals and limited concern about major spread widening unless a full recession materializes, with recent primary supply generally clearing well. One striking theme is the market's enthusiasm for hard asset-backed credit tied to the AI and digital infrastructure build-out. Data center operators, power infrastructure platforms, and related issuers have raised large amounts of debt this year, often at terms that look more like investment grade than their business histories might suggest. The rapid repricing of a major space and satellite operators' bonds, from double-digit coupons into the mid-4% area, as it refinanced roughly $17.5 billion with a new $20 billion facility, illustrates how investors are rewarding tangible assets and perceived strategic importance. With the front end of the Treasury curve elevated, some see relative value in short duration, high-quality corporate exposure, especially in investment-grade credit, where carry now compares favorably with recent history. At the same time, there are real execution risks beneath the surface. More than a quarter of announced data center projects reportedly fail to deliver, and AI infrastructure budgets are enormous. So individual deals can be exposed to delays, cost overruns, or shifts in technology standards. The wider ecosystem also bears watching. Private equity in Europe is grappling with energy shocks, geopolitical noise, and very slow exits, pushing many investors towards secondary sales and a stronger focus on cash realizations before committing new capital. In U.S. direct lending, overall redemptions are still modest relative to the $2.1 trillion market, but valuation uncertainty in software-heavy portfolios is encouraging some retail outflows. Overlaying all of this is the risk that any sharp shift in Fed balance sheet policy tightens funding conditions. In that scenario, markets point to high-yield spreads moving above roughly 400 basis points as a key early stress indicator. For now, though, credit continues to behave as if the combination of higher rates, energy volatility, and AI disruption remains manageable. Commodities, and energy in particular, sit at the junction of today's macro risks. Escalating tensions between the United States and Iran have effectively broken the latest ceasefire, with renewed strikes and missile exchanges raising doubts about the durability of any truce. The Strait of Hormuz is described as being close to closed, with only a fraction of normal tanker traffic moving through, often in covert fashion, while oil inventories remain critically low despite increased shipments from other Gulf producers. Industry executives warn that this backdrop could produce sharp, non-linear spikes in crude and gasoline prices if disruptions persist or demand jumps into the peak driving season. Yet the price action so far has been more muted than the headlines might imply. There have been episodes where Brent crude has pushed into the low 90s on escalation, reinforcing inflation concerns ahead of key central bank meetings. But on other days, renewed hostilities have not generated a sustained surge. Robust U.S. exports, now averaging more than 5 million barrels per day of crude and up to 13 million for total products, and the use of alternative shipping routes appear to be cushioning the immediate supply shock. Some base case scenarios still envisage de-escalation over the coming quarters and Brent easing back toward around $75 by year-end, which would help the disinflation narrative. For the real economy, however, current levels are already biting. Global airlines face significant margin pressure from elevated fuel costs, with widespread hedging offering some protection in Europe, but less so in other regions. Carriers are expected to trim capacity into the winter season, which could push ticket prices higher and accelerate industry consolidation. At the same time, domestic travel demand in parts of Asia, including China, Indonesia, and India, remains strong, supporting regional fuel consumption even as Western consumers feel a squeeze from weaker real incomes. Overlaying the oil story is a powerful shift in electricity and broader commodity demand driven by AI infrastructure. Power supply has become the main constraint on new data center construction, with more than 25% of announced projects failing to complete and companies racing to secure grid-independent solutions. This is channeling investment toward power infrastructure, transmission, and renewables, where costs have fallen by roughly 90% over the past decade, making clean energy highly competitive in many regions. Recent deals in this space show strong investor appetite, and several high-profile clean tech listings underscore how the energy transition and AI power needs are increasingly intertwined. Gold rounds out the commodities picture. Even after a pullback, it remains underpinned by ongoing buying from emerging market central banks and heightened concern about fiscal trajectories, which together support a constructive long-term view. In an environment of sticky inflation risk, higher for longer policy, and persistent geopolitical uncertainty, gold continues to function as a barometer of confidence in fiat currencies and policy frameworks. For cross-asset allocators, the key signals now are oil inventories, shipping conditions around Hormuz, capital flowing into power infrastructure, and central bank gold purchases, all of which feed back into inflation expectations, rate paths, and ultimately equity and credit valuations. Stepping back across assets, the picture is one of robust risk appetite coexisting with rising late-cycle strains. Equities still lean on powerful earnings, AI-driven growth, and the signal from a landmark tech IPO, but stretch valuations, narrow leadership, and a surge in equity supply heighten sensitivity to rates and liquidity. Rates markets have embraced a higher-for-longer backdrop as producer prices re-accelerate and the ECB prioritizes inflation over growth, yet bond volatility remains surprisingly contained, putting a premium on upcoming data and central bank communication. Credit spreads stay tight, and funding for hard asset and AI infrastructure projects is abundant, even as private markets quietly repriced and the system grows more reliant on ample central bank balance sheets. In commodities, oil, power, and gold anchor the inflation and safety narratives, with Middle East supply risk and AI power demand capable of flipping the macro story quickly if they move sharply. For allocators, the key watch points are simple but demanding. The path of inflation versus wages, how central banks handle balance sheets and credibility, the trading pattern of new tech issuance, and whether credit spreads or energy prices blink first. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.